All right, today we're pulling back the curtain on a kind of high-stakes financial crime that happens in, well, milliseconds. It's a type of market manipulation that's kind of hidden in plain sight, and it costs the market hundreds of millions of dollars.
$920 million. This is the fine, almost $1 billion that JP Morgan Chase had to pay back in 2020. And this wasn't for some old-school bank robbery, nope. This was for a crime that happens entirely on trading screens, a sneaky practice called spoofing.
So a fine that massive, I mean, it's one of the biggest in financial history for this kind of thing. It just screams that something really, really damaging was going on and on a huge scale. And, it just begs the question. What exactly is this thing that can get you a $1 billion slap on the wrist? That's the mystery we're going to unravel right now. What is financial spoofing, and how in the world does it actually work?
Okay, let's get right into it. To really get spoofing, we have to start with the official definition, which honestly gets right to the heart of the whole deception.
And there it is, straight from the Dodd-Frank Act. Now the key phrase here, the whole shebang, is intent to cancel. See, spoofing isn't just you placing an order and then changing your mind. It's placing an order you never, ever, ever planned on letting go through. That premeditated intent, that's what makes it a crime.
Think about it like this. Picture an auction. Someone starts bidding like crazy, making everyone else in the room think this item is super valuable. So what happens? The real bidders, they get sucked in and they start raising their own prices. But right before the hammer comes down, that first aggressive bidder, poof, they're gone. That's spoofing in a nutshell. It is all about creating a convincing illusion.
So how do traders actually pull this off in the real world? Well, it's not random. It's a calculated, three-part strategy. Let's break down the playbook.
And this just lays out the deception perfectly. First, you have the action. A spoofer puts in these huge orders to sell something, creating a giant fake wall of supply. Then you get the reaction. Other traders see this wall. They panic. They think the price is about to crash, so they start selling. And finally, the goal. Just as the price starts to drop, the spoofer cancels all those huge fake sell orders and swoops in to execute their smaller, real buy order at new, artificially lower price. It's a classic bait and switch.
Now this is where it gets really interesting, because the data tells the whole story. The numbers just lay bare the spoofer's real intentions. Look at their genuine orders, the ones they actually want. They're small, and they get filled over 35% of the time. But their spoof orders, they are massive, but almost never get filled, less than 1%. Why? Because they get canceled more than 95% of the time. The behavior is totally different, because the intent is totally different.
Now you might be thinking, okay, so what? This is just a game between high-speed traders. But it's not a victimless crime at all. This kind of manipulation actually damages the entire market and has real-world consequences for, well, pretty much everyone.
When spoofing is going on, prices are fake. They don't reflect real supply and demand, and that destroys trust. And when traders can't trust the market, they protect themselves by increasing their trading costs, which hits everyone from giant pension funds all the way down to individual investors. It misleads honest people, and really, it damages the whole point of these markets, which is to manage risk.
And the crucial point here is that this damage isn't just some abstract idea. It is very, very real. This is the estimated market loss from the JP Morgan case alone. Over $300 million in damage, all caused by flooding the market with orders that were never real to begin with.
So this raises a pretty big question, right? If these fake orders are placed and then canceled in the blink of an eye, how on earth do regulators ever catch them? Well, it turns out every single trade leaves a digital fingerprint. Let's look at the trail they follow.
Regulators basically turn into digital detectives. They use software to look for trading patterns that are just too perfect, too repetitive to be natural. They flag those massive differences in fill and cancellation rates we just saw. They notice when spoofing happens during quiet, overnight hours, where a big fake order can have an even bigger, more manipulative impact. And sometimes they find the most damning evidence of all, the trader's own words.
I mean, get this. This is an actual chat message they dug up during an investigation. You really can't get much clearer than that, can you? You have traders openly talking about their tactics, confirming this wasn't just some accident. It was a deliberate, well-known strategy. This is the kind of smoking gun that turns a bunch of trading data into a criminal conviction.
And look, this isn't just happening in some abstract corner of the financial world. The data shows it's most common in markets that affect the real economy. We're talking about metals like gold and copper, agricultural products like soybeans and wheat, and energy like crude oil. You know, the actual building blocks of our economy.
Now here's something that might surprise you. You'd probably think this is all done by some rogue AI, right? Supercomputers gone wild? Well, the data from these cases shows something else. The vast majority of convicted spoofing is done manually. It's a human trader sitting at a desk, clicking a mouse, just using specialized tools to place and cancel those orders with lightning speed.
So what does this all mean for the future of our markets? Well, when you boil it all down, what you have is this constant, high-stakes arms race, a battle between the people trying to rig the system and the people trying to protect it.
And that's really the core tension here. As trading gets faster and as algorithms get smarter, new ways to deceive will pop up. But at the same time, regulators and exchanges are building more sophisticated tools to catch them. It's this perpetual cat-and-mouse game, just played out in microseconds on a global scale. And that leaves us with one final, kind of lingering question. We've just unpacked $1 billion deception. But as technology keeps accelerating, you just have to wonder, what new kinds of manipulation are already on the horizon? And will the watchdogs even be able to keep up?